You're watching the Weekly Outlook here at XM.com. Thanks for joining us. I'm Christina Marujos, and with me today is Rafi Boyajian, Senior Investment Analyst. We'll be having a look at the week ahead. Now, Rafi, China is slowly starting to get back to normal after the virus outbreak by lifting some lockdowns. However, markets will be eyeing the GDP report for Q1 on Friday for signs as to how bad the economy has been affected. What are we likely to see in the data?
Well, we know for certain that the Chinese economy did take a big hit from the virus crisis in the first 3 months of the year. Of course, China was the first country where this virus escalated. And having said that, though, it also peaked much earlier. But nevertheless, in the first 3 months of the year, we know that there was a big impact due to the lockdowns. So we are expecting GDP to have fallen by 10% over the quarter and by 6% year on year. Now, that's quite a dramatic reversal of fortunes compared to the 6% growth we saw at the end of 2019. Now, in addition to the GDP numbers, we will also be getting industrial output and retail sales figures for March. So perhaps if we do see some signs of an improvement at the end of the quarter, that could potentially offset some of the negativity coming from the GDP report. On the whole, though, it does appear that markets have pretty much priced in the worst of it. So the question is, are we likely to see any sharp deviations from these forecasts? Now, if you do get much worse than expected numbers, that could potentially upset the current calm we have in the markets, where this week we did see a recovery in risk appetite. On the other hand, if we see much better than expected numbers, that would raise some serious question marks about the validity of the data and would potentially lead to accusations that the Chinese government is trying to cover up the worst of the impact.
Well, Chinese GDP will be especially important for Australia as well, given how closely correlated the two countries are regarding trade. Australia will have a string of data releases this coming week, with most important the jobs report out on Thursday. What is expected in this report, and do you think it will affect the Aussie's impressive rebound posted this week?
So that is right. The employment report, along with the China's GDP numbers, do pose some serious risks for the Australian dollar. The Australian dollar has recovered quite remarkably over the past week, but of course, next week's employment numbers could remind investors that this is only just the beginning of the economic downturn. The jobless rate in Australia is expected to have jumped from 5.1 to 5.5% in March. But still, if overall market sentiment does hold up in the coming week, then we may only see some knee-jerk reaction in the Aussie.
Turning to the U.S. now, the week ahead is going to be busy in regards of data, but investors are likely to focus on retail sales and industrial production numbers out on Wednesday. Now, given these figures cover March when the virus hit the U.S., how bad are they forecast to be, and how do you see the dollar moving?
Well, there's no hiding away from it. The data will certainly be bad. And these two reports will be quite important because they will be one of the first hard data for March when the US, when the virus did take hold in the United States. Now, retail sales had already been quite weak going into this crisis. We did see an unexpected drop in February. As for March, we're expecting retail sales to have tumbled by 7% over the month. Industrial production similarly will be quite bad, falling by 4.2% according to the forecasts. But we may not see the usual reaction in the US dollar, because since this crisis started to unfold, the dollar has been acting as a safe haven. So any worse than expected numbers could actually boost the US dollar if we see market sentiment deteriorating, and therefore we would see again investors fleeing to safety in the US dollar. On the other hand, if we were to see much better than expected numbers, and at the same time risk appetite continues to recover, then the dollar will likely continue its retreat. It has already given quite a lot of ground against its major peers such as the euro and the Australian dollar.
Finally, let's cross the border into Canada. The Bank of Canada is meeting this week, although not much is anticipated given it already cut rates and launched its first QE program. Since the loonie didn't react much to the jump in oil prices, is there anything in the Bank of Canada's meeting on Wednesday that could maybe move the Canadian dollar?
Well, that's unlikely, mainly because the Bank of Canada already had 3 meetings, in fact, in March. It had 2 emergency ones, and the first one was its regular meeting at the beginning of the month. We saw the bank slashing its overnight rate by 150 basis points. They also launched QE. So we're not expecting to get any surprises from the bank at its April regular meeting. And the loonie didn't even really react that much to the jump in oil prices, as you said. So on the whole, it seems that the loonie is mainly being driven by risk sentiment. So at best, we might see some short-term reaction in the loonie if the Bank of Canada, in its statement, hints at further measures, further possible measures if the virus crisis was to worsen.
Rafi, thank you for joining me today, and thank you for watching the Weekly Outlook here at XM.com.